April 7th, just before 9 a.m. And here's the S&P E-mini. Prices are 50.13, all right? Just before 9 a.m. Let me take you through the day to see how prices actually moved and to show you how you can anticipate where prices did move and will move prior to the actual event happening. Here we go. "10 a.m. "11 a.m. 12 p.m. I'm going to take you through the entire day till 4 p.m. Just stay with me. Where was the trade? This is the question. Where was the trade? You're watching as the markets moved, 3-minute candles. Okay, that's it. I've taken you through the day. Markets opened right about over here, 9:30, down here at 49.18, 49.20, around there. How could you anticipate where markets were going to move, okay? Markets opened lower and then they rose up, quickly came down. How do you know where the trade is? There's no way to anticipate where the market is going to go, except if you do a couple of things. Now, you're watching my TradingView chart, and again, this is a 3-minute chart. There are 25 points between each horizontal line. 25 points, my friends. A lot of points. More than most of you, I wager, ever made on a trade. One horizontal line. But is there a way to anticipate where the market is going to go based on the stochastics? This is a relatively fast stochastic. And so the market opened just prior to 9 a.m. and the stochastics was oversold. And so it could be a pretty good guess that the stochastics would indicate that the market was going to rise since they were oversold. Is that the case? No, actually, they did rise right over here. They rose and they basically stabilized for about 10, 12 minutes. Was that the trade? Of course, you're looking at this, but you can't anticipate that. So was this early trade the trade? Maybe. Was that the only trade? Well, I'm not going to keep you in suspense longer. And so I use, in addition to the stochastics, the previous day's close, which I mark on my chart. I'm going to show it to you here. Here was the previous day's close. Gap trade closes 70 to 75% of the time. Pretty good guess, right? And so the trade was up to the gap. Was it? Was that the trade? Don't know. Nobody knows where the market is going to go, except the stochastics indicated an oversold position down at 9:30, just when the market opened. So it would have been a pretty good trade to guess to the market upside. Was that the trade? Yes, that was the trade. Was that the only trade? Well, let me show you further my calculated trading zone where the market was likely to trade. Okay, and here is how I laid out my chart. And I laid this out, not only the previous day's close at 51.05, but also the Taylor calculator resistance at 52.11, support at 50.30. And so it was a pretty good guess that the market was going to go into the Taylor trading zone and close the gap. But was that the trade? Was this the trade here? Can't anticipate this huge move up, very fast move up. And this was a 188 point calculated trading range for the day. I'll get to that in a minute. And so the trade was, in the morning, the stochastics indicating an oversold position up into the Taylor calculated support level Was it going to go higher? Well, right over here, there's no way to know. There's no way to know that this is going to happen. Get off, okay? And so we go further. The market rose up. It was overbought, but again, no way to determine it. And so where's the next trade? Right over here, where prices came down, didn't take out the morning low, went back up to the previous day's close at 51.10, 51.11. That was the trade. These were the two trades. Again, this looks great. Gee, if I made this trade, it would have been terrific. If you made the trade, it would have been terrific. If you won the lottery, it would have been terrific. But you can't anticipate that. You can anticipate with the stochastics oversold here at the market open and the trading zone over here, and you can figure that the prices are going to trade within the trading zone, and the previous day's close equilibrium was at 51.11, that the market was going to go there. So here was one trade right here, and here was the second trade right over here. Again, you can't anticipate this. All right? I'm sorry. If you think you were going to catch this move, maybe, but the indicators didn't talk to you in that manner. Okay, so that was Monday, April 7th. Let's go further to Tuesday, April 8th. Now here was my calculated trading zone, 330-point calculated range right over here. Okay, support at 48.13, resistance at 51.39, previous day's close 50.98. Huge trading range, all right? Market opened, and this is pre-market, this is 8:45, all right? 8:45, I'm going to take you through the day as the market traded. Remember, the trading zone calculated that the likely price action was going to be lower for the day. Prices opened, went up for the first half hour or so, then look at where they went for the rest of the day. Again, I'm going to take you through the entire day of trading. And there we go. We hit the previous day's close at 5,100. And as the day progressed, and here we are at the 4 o'clock candle, 4 o'clock Eastern time, and here is where the market traded. Traded up here. Trading zone was indicating prices were going to trade within a lower range. And so we used the trading zone to carefully figure that the market is going to trade within the trading zone. But again, we're looking at a 333-point range for the day. And so if I clone the trading zone, and I've made many videos talking about cloning the trading zone. I'm going to clone it to the intraday high. Okay, here's my clone. I'm going to clone it to the intraday high right here. And where was the other end of the day's candle? Exactly where the Taylor calculated trading range said that the market was going to trade. So that is the power of using Taylor, using the previous day's close, and only the stochastics. I didn't use the stochastics on Tuesday, April 8th. But nevertheless, this is how to trade, my friends. This is how to trade. And if you don't know anything about the Taylor trading zone, George Taylor's formulas, read his book method, Taylor's book method. It's an impossible book to read. You can, I've calculated the formulas, and you can see them right here. This is exactly what I do every day. I put the open, high, low, and close for each day. The rest of the numbers are calculated out automatically. It looks complicated. It's not. And I use three numbers. I use the average sell point, which is the intraday, which is the resistance level, and I use the average buy or the support level, and I also reference the range, which is the difference between the support and resistance, the numbers in the yellow columns. And this is all done automatically. So if it's too difficult for you, to put 4 numbers in each day into the Taylor calculator, I don't know what else to tell you. This is the best way to trade E-minis, or basically anything else, because George Taylor was a genius. His formulas are based on a dozen calculations, which come down to an average of averages, and it's basically the best way to trade E-minis, NQs, almost anything else. So that's my video for today. Thanks so much for watching. Trade safe, Marv Eisen from Timeless Dollar Trading Academy, and I'll see you in my next video.